I have been asked many times and constantly which stocks from my personal watch list I want to own next. And today, I'm going to show you 3 that I can't wait to buy if and when the price is right. These 3 stocks are on my forever list, and I've done the research, crunched the numbers, and know exactly what price I would pay for each one, and I'm going to share that with you today. Now, most investors want to know, what would you buy right now? They ask it of everybody they can talk to. It's a way of getting ideas from other people or shortcuts. In fact, just the other day, we were doing a community live stream, and someone asked me a great question. I have a video where I talk about 33 companies that I want to own forever. Now, guys, here is the list. If you don't remember the video from last year or the year before, here is the list of our 33 stocks that I want to own. We have a PDF download. It was our most popular downloaded PDF to date. It goes through all 33 stocks that I own, why I want to own them. If you're interested in seeing that, click the link below, absolutely free. You will get the PDF emailed to you in a matter of 1 minute. But in it, they said, from your list of 33 forever stocks that you have talked about, which ones don't you own yet that are on top of your list? So obviously, we sit there and we use these kind of questions to create videos. So in this video, I'm going to walk you through the 3 stocks that I would buy today if they were priced at fair value. So I'm going to walk you through why they made the cut, how I analyze their value, and then that will spit out, when we take the story and the numbers together, it'll spit out the price that I would feel comfortable paying for each one this very second. Now, if I love a company, why wouldn't I buy it? Well, this is exactly the issue I have with the regular retail investor out there. They hear it, and this is the way I was 25 years ago. You hear a great story, and you're like, listen, this is a great story. This company is going to kill it. I want to own this company. Well, guys, our 5th tenet of our principle-driven investing, and the most important one, is a great story can become a bad investment if you pay the wrong price. If not, my question to you is, well, why not pay $100 trillion for the best story out there? Well, that would be 3 times larger than the entire US economy. Why not? You might sit there and say, well, that's extreme. Is it extreme? Is it any more extreme than half that price? Yeah, it's twice as extreme. Yeah, but at a certain level, it's just insane. You've got to remember that a great story can become a terrible investment. You've got to be aware of where the numbers and the story come together. For example, look at NVIDIA. It's a $4 trillion company. Great company. It's been around for almost 30 years, something like that. Well, then why didn't you pay $2 trillion for it 30 years ago? Well, because you'd only doubled your money. It was a great story, became worth $4 trillion. Why didn't you double? You could have just doubled your money. Well, doubling your money in 30 years is a shitty return. It's a little over 2% return per year. That's terrible. Not to mention all the other great stories that never amounted to anything. You're going to lose all that money along the way. Now, if you're new to investing, I really want you to stick with this because this is such a great way of learning. You're so lucky to have YouTube and people to go sit there and hear from. I'm going to go through the basics of these 3 companies, why I love the story, then go look into some numbers. I'm going to explain different metrics that I look at. And then we're going to go finish off every single company with the price I'd pay using our extremely simple yet highly effective stock analyzer tool. We believe in making investing as simple as possible, but it doesn't make it easy. The hard part is right here. Because usually to get a good price in a company, you've got to let Mr. Market, the people out there, be a voting machine saying that they hate the company. That's what needs to happen usually. I'm here to get you to start thinking more about how to look at buying a stock as buying a piece of a business. You're an owner of a business, and the stock market is just there to give you an opportunity to buy stocks at better prices. Just because a stock goes down doesn't mean that you are wrong. It just means the market thinks that the company stinks. So let's jump into the first stock on my forever list, and I'll explain not only why I love it, but what price makes sense. Stock number 1, Microsoft. Guys, I love this company for several reasons. One of which, I know a lot of people hate him, but when I was a kid, I was absolutely fascinated with Bill Gates. I absolutely loved the guy. And Microsoft was one of the it stocks of the 90s, and it fell into absolute hatred by 2010. Why? Because the stock went from $52 a share down to $11 or $12 a share. And everybody said it's a dying business. And I was like, well, but wait, revenue's going up 7 or 8% a year, profits double-digit growth every year. How can it be dying if that's happening? Guys, it's got a lot of margins. So what I mean by that is 70% almost gross margin. Every extra dollar they bring in, 70 cents of it goes to pay overhead and taxes, as opposed to like a car company like Tesla, for example, is 15 to 18%. Software businesses have very, very high gross margin. And look at this, bottom line margin of 35%. That means after all overhead, after all taxes, over a third of the revenue they bring in goes to profit. Guys, that's insane. Companies like this are able to use very little money, increase the revenue, but really increase their profit. And usually those lower margin businesses actually take a lot more money to increase their profit. That's the funny part. Now, some other things. $3.83 trillion market cap. This means all the shares times the number of shares outstanding versus a $4 trillion enterprise value. That difference is $170 billion. That's a lot of money. That's their debt. It's not a lot of money when you consider they made $70 billion last year in free cash flow. They can pay off all their debt in 2.5 years if they just replicate last year. And guess what, guys? Based on their history, they're probably going to make more money next year than this year, and so on and so forth. Guys, they're everywhere. Microsoft is absolutely everywhere. They're ingrained in our lives. Microsoft Office, Microsoft OneDrive. I love Office 365. Now, you might sit there and say, well, Google does that. Yeah, but Google doesn't have the list of software that this company has. Now, our users have a buy rating on Microsoft. They love Microsoft. The great thing about Microsoft also is they have this little metric right here, return on capital of 19% over the last 5 years. What does that mean? That means when they invest money in the business, they get a high rate of return. Theoretically, it means if they invested $1 billion in their company, they should be able to generate $200 million a year on that $1 billion over and over and over again. Companies that have high returns on capital are companies with a very large moat. They have very good protection on their company. This is incredible right here. So let's see what the 8 pillars look like on Microsoft. Well, it's one of our favorites. 6 checks and 2 X's and 2 X's are the valuation metrics. They're selling for a high earnings multiple over the last 5 years and a high cash flow multiple. Doesn't mean it's expensive by itself. Think about it. If 2 companies are there, they're exactly the same, everything's the same, but one can grow at 20% a year and one can grow at 5% a year. Should you pay the same price? Of course not. Of course not. You should pay far more for the one growing 20% a year. That's the key here. What's the growth rate that needs to be done to justify paying a premium for this company? That's something you have to understand as an investor. Because I used to do it the wrong way, which is every company was a 15 PE because that's the historical average. No, there are companies out there that deserve a premium. That's really, really important to understand, especially if you're new to investing. Skip the 20 years it took me to understand that. Now, hopefully, you've understood some of the things, but in all likelihood, a little bit of this is overwhelming, and that's okay. You're not alone. You have the YouTube, you have our channel, and I'm here to simplify this as much as possible. If you're new and something in here needs a little more clarification, do me a favor, comment below on what it needs, because we look at the comments to explain more detail later on other videos we do. Now, remember, in just a few minutes, I'm going to go through the price I would pay for Microsoft. But in the meantime, let's see what analysts think. Analysts think that analysts think that in the next year, Microsoft will make $15.38 per share in profit. So they take all the profit divided by the number of shares. Every share you own, you'd get access to $15. They think it's going to grow to $23 a share in the next 3 years. That's 12% growth, 17, 13, and 15. Guys, this is a $4 trillion company that can grow its profit double digits per year still. And revenue-wise, look at this. 14%, 13, 14, 12, 12. I'm not going to lie to you. I don't understand how their profit growth is the same as their revenue growth with such a high margin. I don't understand that. You know what's interesting also? Microsoft's CEO came out recently and he said that they're going to save $500 million per year just off of the people, unfortunately, they've laid off because of AI. They said AI writes 20 to 25% of their code right now. So we have a story, we have numbers. Let's put it together in the stock analyzer tool to determine the right price to pay for Microsoft. And here are the assumptions I made. You might agree with them, you might not, but that's the point of investing. So I did a 10-year analysis. First line is revenue growth. I want low, middle, and high. I put 6%, 9%, and 12%. Now, guys, keep in mind, In the last 10 years, they did 12%. In the last 5 years, they did 11%. In the last 1 year, they did 14%. This number seems very, very low, especially what analysts also think. So I might be too conservative here. Profit margin. What's their profit margin going to be in the next 10 years? I put 32, 34, and 36. And then for free cash flow, I put 28, 31, and 34. I'm just comparing over the last 10 years. And every single time, free cash flow is lower than their profit margin. It's pretty close. You go back 10 years, but in the last 5 years, it's been very different. My guess is they've been spending a lot of money on capital improvements to build data centers as they build out their Microsoft cloud computing. PE. What's the PE and what's the price to free cash flow that this company should sell at 10 years from now? Well, like we said before, it's a large company, has a moat, has a high return on capital, which all justify a high PE. From here, I would start at 15 for normal companies and say, well, Microsoft's a premium company. So guys, I put in 20, 23, and 26. Now, you might hear that number and go, too high. Okay. Too low. Okay. I don't know the right number. We're just trying to sit there and put in numbers here, low, middle, and high to see, are we even close to a number? And then the final thing we do is, what's our desired return? Now, guys, I always put in 9%. This is my way of saying, what's the company worth in a normal market? To match the market return. But guess what? You're not here to match the market by buying individual stocks. You're here to beat the market. If you're going to match the market, just buy a low-cost ETF that'll include Microsoft and don't have to think about it. But if you try to beat the market, you need a margin of safety. You need a higher desired return than 9%. But I want to have it here to see what's the company worth. So I hit the Analyze button, and boom. I have a low price of $230 to $260, high price of $550 to $580, middle price of $360 to $400. Guys, based on today's price of $513, if I bought it right now, and my middle assumptions occur, I'm going to make about 4.5%. That's not adequate for me. So even though I love the story, that return is not good enough for me. Now, I might be conservative above, but it also doesn't even include my margin of safety. So for me, I'm just going to wait and be patient, have it on my watch list, and every few months or every year, I will update my numbers here to see if a new price is given. Stock number 2, Ferrari. Now, Ferrari is a lot different than Microsoft, but the reason I love Ferrari is the exclusivity. I talk about it in-house here. We talk about our software and the thousands of users we have. And I always say, I want us to be Ferrari. I want us to have a top quality product that people are on a wait list. A company like Tesla, which is a small company, is going to sell 1.7 million cars this year. Ferrari is going to sell 14,000 or so. That's exclusivity. All they want to do is sell to people who they choose deserve their cars. This is the story that I love about Ferrari. They could easily double their sales, and they choose not to. They could easily triple their sales. They choose not to. What's more important to them is their brand. Talk about a great story. Other things I love about Ferrari, the average car company is making 15 to 18% per car they're making. Look at Ferrari, 50%. They average 50% per car. Their bottom line profit is higher than other car companies make per car. It's absolutely incredible. What I also love is their free cash flow is getting better. They did $830 million a year for the last 5 years, but last year they did $1.4 billion. This is an absolutely incredible business. It's a premium company. It's funny. People tell me Tesla is not a car company. It's a software business, yet everything in the world says it's a car company. Every metric, everything. You know what the funny part is? I don't believe Ferrari is a car company. Yes, 100% of its revenue comes from cars, but it's a lifestyle business. It's a business that's about exclusivity. It's like Hermes. It's these companies that sit there and say, do you want to be part of our club? Great, go pay for it. That's incredible because Ferrari sits there and says, listen, we're only going to sell 14,000 of these bad boys a year. Proof just that you want it. That's absolutely incredible to me. And look at this. Car companies have very low returns on capital. They got to spend so much money to make a little bit of money. Not Ferrari. Last year, they did the same thing as Microsoft, 19.24%. That's the same that Microsoft did. And this is a company that needs to build factories to build their product. They could easily increase their price by how much and probably be fine. That's another thing Ferrari's doing. They do such a great job of protecting their brand. Let's go look at their 8 pillars. All right, so they have a little bit of debt, but remember, their free cash flow, that's based on free cash flow. Their free cash flow is up a ton in the last 1 year. But what I don't like is, look at their 5-year price of free cash flow. 110, their 5-year PE is 73. Phenomenal story. Is it too expensive? Let's go to the analysts. Let's see what the analysts are saying here. Well, analysts are expecting about 35% increase in profit over the next 4 years, from $10.56 per share to $14 per share. Not as much as I would have thought. My guess is Ferrari can probably do better than that. And their revenue growth, $8.5 billion to $10.6 billion, that's 20% increase, 25%. I don't know, it doesn't seem really believable to me. But our job is to stick it in our stock analyzer tool and see how it looks. Here are the assumptions I made on Ferrari. 4, 7, and 10% revenue growth for the next 10 years. Profit margin, I did 19, 20, and 21. Now, free cash flow, my guess is it's going to get pretty freaking close at some point to their profit margin. So I'm going to increase my free cash flow before. Years ago, it was way lower. But they're probably building factories, putting a lot of money into the company. Because remember, free cash flow is cash from operations. How much are they making running the business minus the money they're investing back into the business. For a company like Ferrari, it means factories, plants, all these other things that are very, very expensive. Now, what PE and price of free cash flow do you put on Ferrari 10 years from now? Guys, I put 20, 25, and 30. I think this is a more premium business than Microsoft. In fact, I'm going to go even crazier. I'm going to go 22, 26, and 30. I look at this saying, what world do we live in that 20 years from now, Ferrari's gone? What world do we live in 20 years from now, Ferrari's building 1 million cars a year? It's not like Rolex. Rolex does a great job of selling a ton of watches, but still being exclusive. Ferrari's not, their goal is not to do that. Their goal is to sit there and say, we only want to be super exclusive. We'd rather sacrifice sales. That means that their PE should be much higher. And finally, same 9% desired return. Now, so Ferrari is probably a hyped company. Everybody loves Ferrari, but is the stock high flying? That's the question. 25 years ago, guys, I was the person that just chased the story like everybody else out there. I would follow a tip. I remember once losing all my money on a tip from my sister's boyfriend's father. I got caught up in the hype and I hoped that something would stick. But I realized very soon after that that wasn't investing, that was gambling. And this is exactly why over the years, everything money was created. To give people like 25-year-old me the tools, the strategy, and even more so the community that I could go learn from. You know, Michael Burry was discovered from a community, from message boards. That was a 20-some years ago community. Now it's actual communities being built. So when you join EM, when you join our software, you're not just getting all the amazing software and the tools, especially our stock analyzer tool, which is used over 1 million times per year. You're getting a foundation. You're getting a way to be able to talk to everybody the same way. And great news is, it doesn't matter if you're a beginner or advanced. So there's tons of people in all categories all across the board. We integrate you into the community by helping you watch courses that we have exclusive to our community, so we all speak the same language. We get you engaged in our community with other investors who are also trying to level up their investing game. And guys, the great exciting part is we're about to add brokerage access to our platform. This doesn't mean we're going to have a brokerage. It means you use your brokerage and tie it into the software so you can make your trades as you see them. Instead of click, close the window, all that stuff. Nope, it's all integrated fully and all the top brokerages are going to be in there. This is the next chapter for Everything Money and we want serious investors to be part of it. But that's the key note there. This is only for serious investors. This is not for people that want to chase the next shiny object. If you're not ready to follow a process, if you're not ready to stick with it, if you're not ready to do the work, don't sign up. Learning is actually fun. Getting better is fun. And all the best investors I know are continually to learn. If you're committed to investing the right way, I highly encourage you to start your 7-day trial today. Click the link below. We have limited spots every day. And we don't know how long we're going to keep the trial open because we want to become like Ferrari and have this be like an application process. So if you're serious, this is your moment. Sign up. I assure you, you will not regret it. So let's finish up with Ferrari. I hit the analyze button. Remember, there's still one more stock to come. Guys, I have a low price of 150 to 170, high price of about 400, middle price of 250 to 265. So it's a ways away from our price currently, and you might sit there and say, oh, Paul, it's too far. Guys, great companies fall over 50% all the time. Look at Nike. It was at 180 just 3 or 4 years ago, and now it's in the $70 range. It got as low as $50-something. That happens all the time. So We've covered these two, what I think are rock solid companies. But the third one, I picked this one because I think it's probably the most misunderstood one that I've been circling for the longest time. It's Google. The googly moogly. Guys, Google.com is a verb, and it owns 85-90% of search or something crazy like that. And YouTube.com is the second largest search engine on the planet, and they own both of them. Guys, I have been so close to buying Google so many times, and I absolutely regret my price years ago was $80. I got to $83. I didn't pull the trigger. I've been selling cash secured puts over and over again to get Google at a certain price. Now, the good news is I've made money on that cash secured put, but I've never gotten the shares. I'd rather have the shares. $2.37 trillion market cap, $2.4 trillion value, enterprise value. That $40 billion difference is their debt, and they generate over $60 billion a year. In 8 months, they can pay off all their debt. Our users, 32 community members, have it rated as an average for a buy. Nobody has it as a sell, which is kind of surprising, but I think you'll see why shortly. Now, guys, returns on capital, getting better, not as good as Microsoft, not as good as Ferrari, but 15.5% in the last 5 years, 16.5% last year, 60% gross margin, 26% profit margin in the last 5 years, but 31% last year. Could they be on another upswing to get a higher profit margin? Revenue growth, big time. 10% a year for the last 3 years, 17.5% for the last 5 years, 18% for the last 10 years. Guys, they're still going to own search. And I know a lot of people are saying, no, AI is going to change that people aren't using Google anymore. Maybe. I don't think the data shows that, but there's always a story attached to some reason why companies maybe have somebody penetrating their moat. Let's look at their 8 pillars here. Again, like Microsoft, 2 X's, pretty much like Ferrari. Ferrari had a little bit of the debt thing, 2 X's, and the rest are checks. But they're not as overvalued from a ratio perspective as Microsoft. If you remember, Microsoft was in the 50s and 60s. This is 30 for a PE ratio over the last 5 years and 36 for their price to free cash flow. So it's already feeling like it's a little bit better. Analyst estimates. And here's what's crazy, guys. They have pretty much the same, actually better earnings per share growth than Microsoft. 19%, 6.5%, 14.5%, 11.5%, 21%, growing from $9.86 per share this year to $16.27. What about revenue? Double digit, 10.5%, 10.5%, 10.5%, 11%, 11.5%. All huge. Guys, analysts think they're going to be doing $600 billion a year in revenue starting in 2029. $600 billion per year. So you have the world's largest search engine, both of the 2 largest search engines, they dominate. They're expanding, they're growing into new markets. Guys, remember, they don't touch China yet because Google's banned there. Who knows what's going to happen there, but Google is absolutely incredible. So what is the price for Google that makes sense, that marries the story and the numbers together? Well, guys, I did a 10-year analysis. I might be lower on the revenue growth. I did 4%, 8%, and 12%. Profit margin and free cash flow, I did 22, 24, and 26. And remember, they did 26 in the last 5 years, and last year was 31%. Was it a fluke? Who knows? This could be something this could be very conservative here. PE, I did 20, 23, and 26. Keep in mind, guys, the current PE is 20. Remember, that other PE on the 8 pillars was the 5-year PE. The current PE is 20. Seems pretty reasonable for a company like Google. And my 9% desired return, I hit the analyze button, 130 on the low side, 350 on the high side, 216 in the middle. At today's price, in the middle assumptions, you're at a 10.5% return. If I'm being too conservative, this looks like a company I should be paying more attention to. Guys, you don't need 100 stocks. You need a few great ones bought at the right price. And earlier this year, I picked my own 7 amazing stocks to go head-to-head against the Magnificent 7. And guess what? It's very short run so far. It's only been 7 months in, but mine are winning. And they're not these hype stocks. And I'm not talking about theory. I actually own these stocks, and I put these picks to the test, and they're outperforming the market's biggest names, even NVIDIA, which has gone up and down all year. So click on the video on your screen to see which 7 stocks are beating the Magnificent 7 and why I think that they will keep winning for years to come. Thank you for your time.